We also observed that many investors are drawn towards stock markets. Why not direct equity?
After doing so much effort into building this portfolio, the returns are suboptimal. They are performing so bad compared to the mutual fund.
How many mutual fund schemes one should have in one's portfolio?
What we do at Truemind is select 4 to 5 AMCs. Then within these AMCs, we look at diversifying across not more than 10 to 12 schemes across equity, debt, and gold. This exposure can also be taken outside India. Opportunities are not just in India.
What about the allocation to large cap, mid cap, and small cap schemes?
We have been out of mid and small cap since last 1.5 years in all our clients' portfolio. We knew that the valuations are very expensive.
And they were very bold call.
But we have to go with what we believe in. The conviction is very much needed in portfolio management.
Welcome to True Money Talks, a brand new podcast series on personal finance presented by Truemind Capital. I'm Shivani Chopra, your moderator for the day, and joining me is Sumit Duseja, co-founder and CEO of Truemind Capital. Welcome, Sumit.
Thank you, Shivani. It's great to be here.
Our topic for the day is how to build a solid mutual fund portfolio, and this is going to be part 1. In this particular episode, we are going to talk everything about portfolio structuring. So, Sumit, the right note to start this podcast will be to help us understand what makes mutual funds such a smart choice, especially as compared to the other investment options which are available.
What I believe is that mutual fund is the most effective way to take exposure towards various asset classes like equity, debt, and gold to help create, grow, and preserve wealth. It's tax efficient because unlike many of the debt products which are taxed as per the slab rate, there is a lower taxation because of long-term capital gain advantage in mutual funds. Then it's professionally managed. There is a fund manager with years of experience, skills, and understanding about capital market who is managing the portfolio on a full-time basis with a strong research team. And they are able to spot the opportunities and navigate the portfolio according to the investment objective of the particular fund at a small fees at what they charge. Third, it's liquid. You can encash your investments from mutual funds within 2 to 3 days. Unlike many other products where there is a lock-in and you're stuck for maybe 7 years, 8 years. Another advantage of mutual fund is the investments are completely transparent. You can look into the portfolio at any point in time. You can see what are the stocks being held in a particular portfolio and what sectors exposure is there, what is the expense ratio, what are the returns on a regular basis. So that gives a lot of transparency to understand how your portfolio is doing. Next, the most important aspect of mutual fund is the cost efficiency. Unlike many products like some of the investments which are linked with insurance, mutual funds have a very low cost structure. We did a study sometimes back evaluating the cost structure of insurance-linked investments and mutual funds. We were astonished by the amount of expense ratio being charged on an insurance product, which came out to be roughly 12 to 15% every year for the 3 years period. That's a significant cost that one is paying, which is compared to a mutual fund. In mutual funds, you're paying only 2 to 2.5% expense ratio in a regular plan. In direct plan, which are zero commission investment option, you end up paying 1 to 1.25% annually. So one thing that is very important for anyone who is looking to invest in the capital market is to understand whenever you invest, the money will either go to equity market or debt market or to commodity market, right? Now, through which funnel these investments are being channeled, the cost of that funnel is very important to consider.
Because that will determine your net returns.
Certainly. So if the cost of the funnel is very high, your net returns would be lower. Whereas in mutual fund, the cost of that funnel is less.
We also observed that many investors are drawn towards stock markets. Why not direct equity?
So see, I have been working as an equity research analyst for about 3 years. I was on an institutional fundamental equity research desk in Mumbai. I covered various sectors like consumers, logistics, media, credit rating, NBFCs. So whenever I used to pick up a stock to write a report on and understand the company business, it used to take around, roughly 1 month to understand the entire business, to understand the future potential of that business, it requires macroeconomy and microeconomy study, where the revenue is coming from, what factors which are driving the revenue. You have to understand what are the costs involved, what is the cost of raw material or cost of services that are being given through this company. The most important aspect of investment is understanding the valuation, whether what you're investing at is the right price, whether it's undervalued or overvalued. So the exercise after understanding the business is to identify its intrinsic value, which again is a very skill-based exercise and comes with years of experience.
So intrinsic value is the true value, the fair value that ought to be for a stock.
Right. And it is determined using your understanding of whether you want to value it basis on a price per earning multiple or DCF or price per book value. It varies from industry to industry. So having this understanding is very important. We have seen many equity portfolios of the clients who we onboarded. We usually, do entire portfolio audit to understand how their current financials look like. And believe me, Shivani, I have seen such poorly constructed portfolios. There would be some 50 plus stocks with irregular positioning or weightage in the portfolio. The multiple portfolios I have seen, random stock picking, where some stocks contributing, one stock contributing 10% or 20%, 30%, and there would be 20, 30 stocks contributing probably 0.5%, 1%. So it is just creating a clutter and no clear direction of portfolio construction and management.
Construction in a very arbitrary manner is what you have observed, wherein in a mutual fund it will be much more organized and structured.
And you know what, after doing so much effort into building this portfolio, the returns are suboptimal. They are performing so bad compared to the mutual fund. Then I wonder, you have put in so much time, you have put in so much effort, and still, you are not getting the returns that you are desiring. To be able to generate higher returns than mutual funds, you need to have that kind of skills and time. And to develop those skills, you need that kind of temperament, you need that kind of inclination, and of course, a lot of time to hone those skills over a period of time.
Now that we have understood that mutual funds is a very simple product as compared to other products also. So the tendency for people who fall into higher earning bracket, who have built wealth, what they do is, as their wealth increases, they also add more complicated products to their portfolio. For example, PMS. So my question is, will mutual funds continue to play their critical role as and when the wealth also is increasing? So addition of mutual funds, is it agnostic to the level of wealth?
Shivani, see, I completely agree with you. Mutual fund as a product is very simple, and it is useful to meet our end objective, whether to preserve wealth, grow wealth, or create wealth. I won't say that a PMS or an AIF has no utility in the portfolio, but it should always be compared with mutual fund as a benchmark. If a PMS is adding value compared to a mutual fund in a portfolio, then it should be part of the portfolio. When it's very clear that it's adding more value than the mutual fund portfolio in the similar category. Post expenses, post taxes and cost, the expense ratio goes significantly higher in these kind of products, and plus sometimes there are some AIF products where the liquidity is not available easily, and there is a cost you are paying to not have that kind of a liquidity. So it should justify in terms of higher returns. So that's where deciding how much allocation of portfolio towards PMS and AIF, that call needs to be taken very carefully, not just because you're finding it fancy or you're finding it exotic, and because your friend is investing in a particular PMS and AIF, you should have it too in the portfolio. So these calls are taken very clearly, understanding whether it makes really sense to have that in the portfolio because of the cost, because of the liquidity, because of the complexity it adds to the portfolio. One needs to take a very careful call for introducing in the portfolio. And also, it also depends on the portfolio size, because PMS will minimum need 50 lakhs investment. AIF will need minimum 1 CR of investment. So unless you have a decent portfolio size where you can allocate say 10% or 15% of a PMS, so unless your portfolio size is above 5 CR, you should not be looking at PMS. Unless your portfolio size is above 10 CR, you shouldn't be looking at an AIF product.
Sumit, I think we should be also talking about the most important question, since we are talking about portfolio construction today of mutual funds. How many mutual fund schemes one should have in one's portfolio? Many believe the higher that they have, the better it is. But is it really true?
See, diversification is important, but over diversification is not needed. Under diversification is also not right. So there has to be appropriate level of diversification. What we do at Truemind is select 4 to 5 AMCs. So different AMCs have a different way of managing investment. So diversify across different AMCs, which could be 4 to 5. That we believe is sufficient in a portfolio. Then within these AMCs, we look at diversifying across not more than 10 to 12 schemes across equity, debt, and gold. So which means that each scheme will have an exposure of roughly in the range of 5% to 15%. So it has a concentrated portfolio which can be easily tracked, which is managed in a very focused manner. So any scheme which is not doing well, you get to understand quickly and then you move to another scheme. So having a concentrated approach like this gives us benefit of diversification, plus it helps us get returns higher than the markets, because we have very carefully selected certain funds to represent our portfolio, which we are tracking and changing when there is an underperformance.
I believe the next question will be that if we tell investors they have to 10 to 12 schemes in their portfolio, they'll figure out how much money do they have to invest, let's say rupees 50 lakhs, and they'll very quickly start looking out for which mutual fund schemes to invest in. What is the missing link here?
See, I mean, before you even start investing, there are two important aspects that you need to look at. One is understanding why are you investing? What is the purpose of your investment? Whether you're making investment for your children's education or for your financial freedom or retirement corpus, or you are making this investment to preserve your wealth or create wealth or grow wealth. There could be a goal also, you want to reach a certain wealth level with your investments. So understanding this is very important, and it comes from an exercise of financial planning, where it's important to see what you're currently investing in, whether that's right or not, and what changes are required to be done. Then you have to see what goals you have to achieve, and whether your current investments and savings will help you reach that goal or not. If not, then what needs to be done? Whether you should increase your savings or you should postpone your goal time, to get a clear understanding of where we are, where we want to reach, and how we'll reach. So having a roadmap to our goals is very important to begin investment. Once we have that clarity, then we understand how we need to behave with our spending and our savings. So that brings more discipline and a focused approach towards where I am going. It's like simply, you getting on a train and you don't know what is your destination. Then it makes no sense. Similarly, for investments, you need to understand where you have to reach.
So financial planning is the first missing link.
So another very important aspect before you start investing is to set right expectations. And how you set right expectation is by understanding your risk profile. Once you have understood your risk profile, for example, how much volatility you can bear in your portfolio markets, when you invest in equity market, which is very necessary to be able to beat inflation and to preserve your wealth and create wealth, it's important to understand that markets have volatility and what level of volatility you are comfortable with, so that you can continue to be in the game for long term and take advantage of compounding to create wealth. So this risk profile will determine whether you are conservative, moderate, aggressive, or very aggressive investor.
Okay, so 4 buckets: conservative, moderate, aggressive, very aggressive.
Yes.
So 2 missing links here: risk profiling and financial planning. Sumit, moving on, can you give a quick example of how would the math work to build a retirement corpus?
So for example, if you are 40 today and your monthly expenses is say 1 lakh, you want to retire at the age of 60. Assuming inflation of roughly 7.5%, that means your cost of living, that 1 lakh what you buy today, the goods and services, it will be roughly 4 lakhs at the time of retirement.
At the age of 60.
At the age of 60. So many people underestimate how much retirement corpus and how much expenses they will have to incur at the time of their retirement. And that's why they don't start sometimes early, or they don't save enough or invest properly to reach the target corpus. So for this 1 lakh expenses per month, to continue to sustain the similar lifestyle post-retirement, one needs a portfolio of 12 CR.
And if you require 2 lakh rupees per month, and it's double.
So it is 24 crores. Then 3 lakhs again, it's like 36 crores. People underestimate the impact of inflation on their portfolio. It also compounds in the long run. So you have to be very mindful of the impact of inflation. And if you obviously do not have understanding of how to get to that figure, you should speak to a financial planner to find out what should be your retirement corpus and what situation and position you are in currently to be able to achieve it or not, and what modification you need to do in your life to be able to reach that goal comfortably.
So, in your financial planning, don't forget the retirement planning. And in your retirement planning, do not forget the impact of inflation. For our retirement purposes, obviously, it's a long term goal, and equity plays a very important role while building anything for our future long term purposes. So, talking about asset classes now, specifically asset allocation, which I know is one of your favorite topics, and we will cover it in more detail in probably one of the future episodes. But very quickly for today, how do you go about allocating the money between equity, debt, and gold?
So see, during a financial planning exercise, one can also figure out if there is any goal which is falling within the next 3 years. Then there are goals which will fall after 3 years. So any goal which is falling within 3 years, one needs to allocate completely that amount for debt.
Debt mutual funds.
Debt mutual funds or debt products. Never into equity, because equities are very uncertain in the short term. And short term, I mean 3 to 5 years is a short term period. Ideally, it has to be 5 to 7 years. Now, for your long term goals, which are, say, more than 5 years away, one should have allocation in equity, debt, and gold.
So, beyond 5 years, also, you're trying to say one should have exposure to debt also and gold also.
Certainly. Each asset class has a role to play in a portfolio. Equity help you get higher returns in the portfolio and help you beat inflation. Debt provides stability in the portfolio and quick liquidity as and when needed, because you cannot expect liquidity from equity market when the markets are down. When you want liquidity from equity in a down market, you will exit at losses, which is not desirable, you see. So debt provides stability to the portfolio. So when the markets correct, your portfolio won't correct because of debt. Then it acts as a provision to invest in equity at lower prices. So having debt is very essential in the portfolio, although it may deliver lesser returns than equity in a rising bull market. But in a falling market, you would love debt because then you have money to invest in equity at lower prices. Then coming to gold, we have been recommending to all our clients' portfolio allocation to gold of roughly 15 to 20% since 2018-19 because of macroeconomic factors, which primarily from in the beginning it was more about money printing leading to inflation, then corona, then wars, Russia-Ukraine war, then Israel war with Palestine, then came Trump with further uncertainty in the world. So we have been in the period of uncertainty for quite some time. And when there is an era of uncertainty, heightened uncertainty, that's where gold works very well. It acts as a safe haven. It also grows, it gains when equity declines. So it acts as a great hedge to your portfolio. So gold also has a tremendous and very important role in the portfolio.
Gold acts like a portfolio insurance.
Yes, it's like a portfolio insurance. I never say that you should expect very high returns from gold. I say you should always take gold as an insurance. So if anything wrong happens in the world, given the uncertain world we are living in, there could be many negative surprises. So whenever that happens, gold will come to your rescue. Gold will come to the rescue of the portfolio. When the equities will go down, gold will go up. And that will negate the impact, the decline in equity. So your portfolio becomes more stable. So that's why the role of this, each and every asset class has a role in the portfolio. And you shouldn't ignore it. Have an asset allocation depending upon your risk profile. So for example, if your risk profile is you're a conservative investor, your equity allocation would be less in the portfolio, but it will have a range of equity allocation. You cannot certainly have a same equity allocation at all market levels. For a very aggressive risk profile, the equity percentage in the portfolio would be higher. So certainly, higher your risk profile, higher the return expectation, higher the volatility as well. So when you have designed a portfolio suiting your risk profile, your long-term objectives, and having these asset classes in the portfolio, it helps you stay at peace and also helps you reach your goals comfortably, reduce risk and enhance returns. in your portfolio.
That's the overall objective of asset allocation, employing asset allocation strategies.
Certainly.
To reduce risk and to get higher returns.
Certainly, and I think that's the value add an investment advisor brings to your portfolio. How well your investment advisor or wealth manager can reduce risk or keep the risk at the same levels and maximize returns from a given level of risk.
Coming back to our discussion on the portfolio construction part of building a solid mutual fund portfolio, my next question will be, what about the allocation within the equity mutual funds? What about the allocation to large cap, mid cap, and small cap schemes? I also know that it's like a raging debate that is going on right now with regards to the allocation to mid and small cap schemes. But we would love to hear some general guidelines from you, not from today's perspective, but general guidelines on selecting schemes in such spaces.
See, I never believe that one should have a certain allocation to large cap, to mid cap, or small cap at all market.
Okay. You have no rules of thumbs. For
No rules
example,
of thumbs.
a lot of experts say at least 70% to large cap, 30% to, let's say, mid and small cap. So you are completely agnostic to those.
I am not aligned with this kind of approach. I think what matters is valuation. The only thing that matters is valuation. At what prices you are investing will determine your future returns. So wherever the valuations are good, whether the valuations are good in large cap, and even in large cap, we have two different approaches towards fund management. One is growth approach and value approach. And different approaches work at different stage of the market cycle. Then you have mid cap and small cap. Valuation also matters a lot. For example, 6 months ago, the past returns for mid and small caps were coming upwards of 50% for 1 year return.
Past 1 year return.
Past 1 year return 6 months ago was more than 50%.
And now it's negative.
Yes, we have been out of mid and small caps since last 1.5 years in all our clients' portfolio. We knew that the valuations are very expensive.
And they were very bold call.
But we have to go with what we believe in. The conviction is very much needed in portfolio management. Unless you understand your investment philosophy very clearly, you would not be able to take these calls. You will be able to take these calls when you are very clear about the valuation metrics as well. Many people do not understand how to value certain pockets of stocks or sectors. For us, valuation matters a lot. So we have been allocated to large value portfolios, which have delivered fantastic returns compared to mid and small cap. So if we see the portfolios, right now, mid and small caps are giving almost zero returns or negative returns, and many people holding stocks and high beta portfolios have seen major losses in their portfolio. Whereas for our clients, allocation to large cap value portfolios saved them a major decline in the portfolio. Our portfolios would have declined very less compared to the overall markets. Because
together with the right asset allocation strategy also for the clients.
Certainly, gold also went up. Debt also has been providing stability to the portfolio, and we are now shifting money from debt to equity at lower prices.
That's what you mentioned in the last response also.
Yes.
Okay.
So it's all about valuation, Shivani, that we have to really look at in different pockets of market. And valuations can be very attractive sometimes in a particular sector. So we will pick up a sector, for example, IT sector or a banking sector or a pharma sector. So we need to be very mindful of how the valuations are playing in different sectors and keep on looking for such opportunities to make it part of our client's portfolio. Because when we spot these opportunities where we believe that the downside is limited and upside potential is high, we take allocation of minimum 7-8% in the portfolio, up to even 15% depending upon how much confident we are about this opportunity. And again, this exposure can also be taken outside India. Opportunities are not just in India. We have multiple opportunities, maybe sometimes in US, maybe sometimes in China-oriented economy. Given that current state of perception towards China economies, with a lot of negative perception, the valuations have declined significantly compared to their long-term averages. So we thought, an economy growing at 4 to 4.5% doesn't deserve such low valuation. So we took allocation of roughly 7 to 8% to 10% in China-oriented funds, which have done very well in the last 1 year.
Thank you so much, Sumit. Thank you for all these insights in our episode 1 of building a solid mutual fund portfolio, where we talked about what is the importance of investing in mutual funds. How do mutual funds compare with the other investment products? For example, you have insurance or you have fixed deposits. Even there's an option for going for the route of direct equity also. We also spoke about that as your level of wealth increases for our HNIs or ultra HNI citizens, for them also mutual funds will continue to play a very critical role in building their portfolios. We also talked about the importance of financial planning and risk profiling. Then we also spoke about the allocation between the different assets, which are equity, debt and gold. And also we concluded our thoughts with what should be the ideal allocation between large cap, small cap and mid cap equity mutual fund schemes. So since we are just wrapping up, Sumit, now, any concluding thoughts for our episode 1?
So concluding thoughts are, mutual funds are simple and most effective investment options. One should only consider other products once you do not have options available in a mutual fund portfolio. Second, having an asset allocation plan and having your risk profile and financial plan in place is very, very important. Your asset allocation plan will be determined from your financial planning as well as from your risk profile. Then valuations matter a lot. You should always look at what is the right value for investment, because that will determine how much risk you have and how much potential returns you can get. So any investment should always consider what risk reward I'm getting. So our end objective is to minimize risk and maximize the reward. And that's how a portfolio should be constructed, in a very methodical way, in a very professionally and structured way, which has science, art, experience, and overall behavioral aspect also involved. So there's a lot that goes into building a good, strong mutual fund portfolio.
Thank you so much, Sumit. That's a wrap up for us. Curtains down for our episode number 1. In episode number 2, we'll continue our discussion on how to build a solid mutual fund portfolio. That will be part 2. That will be the last part of this series. And we will be talking about selection of mutual fund schemes. Thank you so much.